What's going on, guys? Mackenzie Long here. Whole life insurance myths debunked. Today we're going to be talking about a lot of the things that you hear about life insurance policies, and I'm going to tell you the truth about it. So today is not going to be a buy term and invest the difference versus permanent insurance strategy. I did a different video on that if you want to go watch more about it. So if you're a buy term and invest the difference guy, perfectly fine. If you're a permanent insurance guy, that's awesome too. If you are undecided, this video really is probably more for you because you're trying to find accurate information about how you want to set up your financial strategy. And you hear two talking heads that talk entirely different things about permanent life insurance. And so being in the industry for 9 years now, I've heard all of the fallacies about whole life insurance or permanent life insurance. It is absolutely not perfect product on the industry. They're all tools, and I think each tool has its own place. However, the biggest challenge about tools in the financial industry is that most people talk bad about products that they don't have to offer, or simply because they don't understand them. And I think that does a huge disservice for the industry because people who are looking for accurate information simply can't find it. If you're going to a particular guy, he's going to be telling you everything negative about all of the stuff that he doesn't offer because he thinks somehow that's going to drive more clients to him. And unfortunately, those are oftentimes the people that we reward. And this happens on both sides of the aisle, so I'm not saying anybody's innocent here. However, my goal on this channel is to give you the most accurate information and give you a lot of what people say and then debunk that so you can make your own decisions. And I think every tool in the financial platform has a place. Well, except for accidental death and dismemberment. What the heck is that for? Can you guys help me? I don't know why that exists. I don't know why people buy it. I don't know why they have it. I mean, unless you're in an industry or career that you get dismembered often, I don't know. I just see arms flying around everywhere. I mean, it's so rare that it seems to happen, and it's more expensive than real life insurance. But anyway, if somebody can help me on that, I would definitely love to learn more about it because it's really the only thing that I don't really understand how it fits into a particular place. Unless maybe you're at a meat factory and you lose limbs all the time or something. So hit me up on that. But other than accidental death and dismemberment, I think there's just about a place for everything. Now, when it comes to permanent life insurance, it is definitely complex and it has a lot of different moving parts. And we're going to talk in generalities today. I don't want to get too specific, but I want to cover some of the myths around permanent life insurance that you'll oftentimes hear that is either absolutely a lie or they simply just don't know what they're talking about. And the first one is going to be that you only get the death benefit or you get the cash value. Now, generally they're talking about a whole life insurance policy or they're talking about a level death benefit in a UL policy. And they are partially true. However, the way they're wording it makes it sound like you're paying for all of the insurance, but only getting part of it, only getting your money back. And that's not entirely accurate. So let me fully explain it to you, and then maybe you'll understand a little bit more. So as you can see in this illustration, we have a $500,000 death benefit. And you're going to see the cash value increasing over time. This is how a normal life insurance policy works. Again, this is going to be more based on a whole life or on a cash value insurance policy where the death benefit is set, but as we're putting money into it, you're going to see the cash value go up. Now, what happens if you die? Do you only get part of the cash value? Do you get part of the death benefit? Well, in these particular two policies, again, the whole life and the level, because the death benefit is the total amount, the $500,000, it's partially true, and that yes, you get the cash value and you get what's left over in the death benefit. Now, why would this ever make sense? Why would you put money into an insurance policy only to get part of it? That doesn't seem to make sense. The reason why this happens is because it's basically the same exact thing as self-insuring. Now, what's interesting is the buy term and invest, the guys believe in self-insuring. That's why they say get a term policy, save a bunch of money, and then that way eventually you don't need the life insurance, you'll just have a bunch of money, which makes sense. And it allows you that time to be able to not need the life insurance. Well, that's basically exactly what's happening inside of the life insurance policy, is that the more money that goes into it, the less you're actually buying of life insurance. It's just doing it automatically. Instead of just one day your $500,000 life insurance policy is gone and now you're self-insuring. The difference is it's gradually doing it over time. So what this means is, in this particular example, let's say it's a 60-year-old who passes away. They have $250,000 in cash value and $250,000 in death benefit. So they would receive a total of $500,000 for their death benefit, half of it being cash and half of it being insurance. Now, they'll say, well, but it's called death benefit, so they're only getting the $500,000. That's not entirely true. They've been only paying for the $250,000 in life insurance because they have $250,000 in cash. This is what allows this policy to not get tremendously expensive over time. Now, going specifically with a level IUL or VUL policy, this is to help keep the cost of insurance down. That again, you're basically self-insuring, that when you're getting closer and you're getting much older, you're keeping just a small amount of insurance to keep it an insurance policy, because the regulations say that you have to have more insurance than you actually have in cash value, so they have to keep some insurance in it, but you're paying for a very small amount of life insurance while the rest of it is cash value and is allowed to grow inside of the policy. We'll talk more about some of the specifications and why you would do that, but that's more of an understanding of you don't just lose your cash value that's inside of it. I hope that helps explain it to you even better. Now, if you were to go into the UL category, IUL, VUL, and do what's called an increasing policy, you could get both of the death benefit and the cash value. However, you would be paying for that $500,000 in life insurance over the entire contract, which may make sense for some people because they might want both, but some people might not necessarily need both and would rather have the cost of insurance go down and would rather have the amount of insurance that they're paying for go down. In either case, if you are going to look at a permanent policy, you want to be max funding it. And this sounds backwards when you're talking about life insurance, because generally you want to pay as little as you possibly can for life insurance. But the difference here is because there's two categories, there's two things inside of a permanent life insurance policy. You have the cash value, which is what you want to grow, and you have the life insurance, which is basically taking a portion of that and paying for the cost of insurance. So the more you can put into the cash value, the better that this policy is going to do. And again, towards the end, we'll talk about some of the reasons why somebody would do that, but mostly because it's going to grow tax-free and come out tax-free. And number two, what you'll hear from these people is often, well, you won't need life insurance when you're older. And I went over this fairly extensively in the term versus perm, so you might want to check out that video. But very briefly, it's based on the X-curve concept. And basically, there's two parts to it. What's supposed to happen is when you're young, you have lots of liabilities. Means you have a new house and cars and kids and income and all of this stuff that you need to make sure that you protect. And what's supposed to happen over the course of your life is this number is supposed to drop. You pay off your house, you pay off your car, kick your kids out of the house, you get closer to retirement, your liabilities are supposed to be low. That's how life is supposed to go according to the X-curve. Simultaneously, you're supposed to be saving as much money as humanly possible so that you can become a millionaire. So you're going to be saving money. Your wealth generally when you're young is very low because you're just entering the workforce and you have lots of expenses. And then it's supposed to go up over time until you get into millions of dollars. And then when you're a millionaire, you can basically retire because you have lots of wealth and low liabilities. The challenge with that is that's not reality in today's society. And I have some statistics to back it up if you may disagree with that. But according to spendmenot.com, only about 1 in 6 Americans actually reach millionaire status in their retirement years. The reason why this is important is because if you're a millionaire, if you have $1 million, you can basically pull out $40,000 per year to live on. That doesn't mean you're living much of a rich lifestyle. $1 million is kind of the entry gate into retirement nowadays. And it's saying that 1 out of 6 Americans actually reaches that goal. Or to give you a percentage, it's about 86% are not doing it, meaning the vast majority of them are still working, meaning their spouse is required on them for their income. Maybe they're still taking care of some kids in some capacity, or maybe now they're even taking care of their grandkids, meaning that their kids would then have to find a way for their kids to go into daycare if the grandparents were no longer around, meaning that they're still needed, they still need some life insurance. The other thing behind this is you're supposed to have your mortgage paid off by the time you're in retirement. And some simple numbers by AARP, over 44%, let's kind of round up if you don't mind, because I think this number is getting much worse. About 50% of retirees still have a mortgage, meaning that they still have responsibilities as they're retiring. And these numbers are getting way worse. They're not getting better. And what's going to happen is we're probably going to be introducing a 50-year mortgage. We're already seeing a lot of this happening in the car industry as well. If you remember, it used to be a 60-month term. It is now extended into 72 months, which is now extending into 84 months. And it's very rare that a car even lasts that long, yet people are taking out these really long loan times. And if we do that with mortgages, a 50-year mortgage, almost nobody is going to have this thing paid off by the time they're in retirement, meaning they're still going to need life insurance when they're older. And number 3, they compare it by rate of return. And they say, well, if you take this life insurance policy and you just buy term and you invest the difference, you're going to have way more money that's going to be invested and you will end up with a lot more money. And that's actually factual. Now, what they often neglect, I think, makes a big difference too. And so let's go through some of those things. Number 1 is a race car can go much faster with no safety equipment and no brakes. That is simply a fact. It doesn't mean that it's necessarily a good idea. So what they do is some interesting things of a guaranteed 9% rate of return on their stock picks, which is fairly interesting. And they oftentimes neglect the 1% fee, but we'll overlook some of these things and how ridiculous this argument really is. And then what they'll do is they'll compare it to a very modest 5 or 6% rate of return. Maybe they're thinking more about a whole life insurance policy, but if you're looking at an IUL, then the rate of return can be much higher than that. Looking at some of my clients over the last year, they were almost 14, 15% rate of return. So 5 to 6% is pretty modest. Not that it's not fair, but however, how come they don't do that with a realistic number from the stock market, including fees, downturns, those kinds of things? Because average rates of return is very different when you start introducing negative numbers. When you're using something like a permanent policy, if you're inside of a whole life or an IUL, you have no risk of loss, meaning that there's no negative numbers in your average rate of return, which changes that number tremendously. A quick, easy example of this is if you take $100 and you subtract 50%, you have how much? $50. Now, what happens if you get a positive 50% rate of return? Well, $50 plus 50% is not $100, it's $75. So they would look at that number and say, well, you had an average of 0% rate of return, negative 50, positive 50. So how is it that I ended up with $75? Now, obviously, when you calculate that over a longer period of time, the numbers don't look as bad, but it simply just doesn't make the same amount of sense when you introduce negative numbers and percentages. The next thing they oftentimes forget is that there's actually a value to the life insurance. That $500,000 never seems to get added back into the consideration of that person passing away with that life insurance policy. They also seem to forget that everything inside of that policy grows tax-free and comes out tax-free. So if you're in the higher income tax bracket between you and your wife, you're over $250,000 a year, you don't even have access to the Roth, so you need to find other ways to get creative to have more tax advantages. They also seem to forget that if you were to have that kind of money into your 401k or your IRA, that you're going to pay a ton of money and lose a ton of money in taxes. It can also affect things like your Social Security. If you're pulling out more than $36,000 per year in income, and remember, everything that's coming from your IRA and your 401k is income, that means you're now going to pay more in Social Security dollars as well. Up to 80% of your Social Security benefits are now being taxed, which is costing you additional money in taxes. They also forget that once you get into certain tax brackets, it can also affect your Medicare. And I think they oftentimes even forget that we're at all-time low income rates, probably, be in a higher income tax bracket. The way we can tell is because of our national debt, how Social Security is doing, how we're doing with medical, and all of those things we seem to be failing at right now, and the only way we correct them is by charging more money to the American people. And we do that through the form of taxes. So chances are you'll probably have higher taxes in the future. Now, all of that stuff gets forgotten, and all we end up looking at is, well, you can get a better rate of return here than you can here. They also forget the ups and downs and all of the other things that go along with that, versus if you're using a permanent insurance policy, you don't have any of the market risk, so you don't have any of the heartache every time the stock market tanks. Now, I'm not saying necessarily that one idea is better than the other. However, what I am asking for is that if we're going to compare them side by side, let's actually compare them. It's easy to take one example and use the best example from this category and a bad example from here and say this one's better. But generally the reason why this is happening is because they work for a company that doesn't offer both, which I think personally is a disservice to the individual. And number 4 is it's purely because of commissions. They would never trick you into buying a permanent policy if it wasn't because they made a bunch of money on it. So they're just a bunch of greedy people who are trying to trick you into wasting a bunch of money. And okay, well, let's go with that for a second and talk about some things that you might need to know that would help you make a better decision here. If that was true, then why is it that the top executives of Fortune 500 companies put their money in life insurance? Why is it that banks put their money in life insurance companies? It makes for a very interesting conversation when you understand where the wealthy put their money. And let's go ahead and get to that idea of it's all about commission. So let's say you sell $1 million life insurance policy, and let's say it's a $10,000 upfront commission. That's a pretty good chunk of money to be sitting down with somebody, go through some numbers, write up an application, and get them some life insurance. It's happened in my career, both on the term insurance side and the permanent insurance side. But then my question becomes, okay, if they were to put this money into a mutual fund that they're investing with you at, let's say, a 1%, which is pretty low considering where most of them are at. They're probably closer, maybe 1%, maybe even closer to 2%. But let's take a 1%, that's how much that advisor is going to make off of them. So let me ask you, if our goal is to get this up to over $1 million, what is 1% of $1 million? Do you know it's $10,000? So they make $10,000 every year that there's $1 million sitting in this account. So let's say it does that for 10 years while they're in retirement, they're pulling money from it, it stays above $1 million. That's over $100,000 in commissions that individual would have for putting them into a mutual fund, not including all of those years to get to $1 million, all of the years after the $1 million, transferring to the future generation and managing those $1 million years for after that. So I think it's a little bit hypocritical to say the only reason why they're doing the life insurance policy is the commission. In this particular example, and in most examples that you would run, you actually make way more money putting it into the stock market and managing those funds than you would doing a life insurance policy. I think the biggest note here, if you're listening to those numbers and saying, wow, that's a lot of money, it's why it pays to work in the financial industry. And you can make really good money doing the right thing for people. You really don't need to go out of your way to do stupid stuff and think about the commission first. So if it's an industry you're looking at, I highly recommend it. It pays very, very well. Well, those are the big ones for today. I wanted to keep this video fairly short so that we can get through a lot of this stuff. It's a lot of information to go through at once. And I'm sure there's probably another dozen or so myths or lies that people tell about permanent insurance. But to me, these are the biggest, most common ones that you will hear. And whether you're a buy term and invest the difference guy, I'm with you. I think that strategy is great in a lot of cases. If you're a permanent insurance guy and adding that to your portfolio, again, I think that's awesome as well. I can find cases where both of them make a lot of sense, and I think it's important to talk to an advisor who can actually do both of them. So I hope this was helpful for you. If there's ever anything that you have questions about or something that I can help with, you're thinking about getting your portfolio going, don't hesitate to reach out. You can find me on any of the social media platforms. Also, please make sure you smash the like button if you learned something today, or at least reconfirm something that you knew about some of these. Also, I would love to hear your comments if there are other things that you often hear about permanent life insurance that you would like for me to answer, or anything in the financial industry related. I would love to do that as well. And also, don't forget to hit the subscribe button, and we have some really cool things coming out that I'm really excited about that you will not want to miss. So make sure you hit the bell as well. And as always, I will see you guys later. Take care.